Okay, this is Sunko, the Korean bro. Today is 2023, December 10th. It's getting hotter these days. I'm currently living in South Korea, and I don't know why, but the climate is really weird these days. Supposedly in December, it's supposed to be cold, right? But uh, like today, like the temperature was like 12 degrees, which is really weird. But anyway, let's see what stock news we have tonight. Okay. CrowdStrike Holdings, CrowdStrike, Cloudflare, CrowdStrike Holdings. Hmm. Excitement about artificial intelligence and its potential to boost labor productivity has sent many stocks higher this year. CrowdStrike Holdings 127% year-to-date return. Elastic, CrowdStrike Holdings have consensus ratings of buy among Wall Street analysts, and neither stock has single sell recommendation. Leader in several cybersecurity markets, and that success is due in part to powerful artificial intelligence. One growth stock down 73%, but right now it's at sea. Okay. Hmm. Rivian Automotive. Hmm. Different kind of coffee house, Dutch Bros. Hmm. Well, let's see. U.S. money supply is declining rapidly. Previous significant money supply contractions have been followed by major economic downturns. However, there's a good reason to believe that this time is different. History doesn't always repeat itself. Predictions about how stocks will perform in the new year are already beginning to circulate. Some think the prospects should be good since the S&P 500 typically rises during US presidential election years. Others foresee a mild recession on the way, which will likely cause stocks to fall. But perhaps the most intriguing prognostications dive into especially arcane economic orders. Some point out that the US money supply is shrinking the most since the Great Depression. Does this spell doom for the stock market in 2024? Plunging money supply. Money supply is simply the total amount of money in circulation. The two most common ways to measure money supply are called M1 and M2. M1 is the total amount of money held by the public in cash, coins, and traveler checks in banks, regular saving accounts, and credit unions. M2 is M1 plus money held in short-term time deposits such as certificate of deposits and in money market funds. Doom and gloom for 2024. Okay. The time is different. So does the shrinking US money supply spell doom for the stock market in 2024? I don't think so. I usually cringe when I hear the four words. This time is different. However, there's a good argument that this time truly is different than the past cases when the US money supply contracted. However, I wouldn't rule out the possibility that the stocks could fall next year. There are plenty of other potential culprits that could cause the stock market to stumble. On the other hand, I won't be surprised if the market rises with continued economic growth, relatively mild unemployment, moderating inflation, and stable interest rates. No one knows for sure whether 2024 will bring a boom or doom for stocks. The one prediction that I can make with confidence about the stock market is that it will go up over the long term. Brookfield, NextEra Energy. Okay, let's look at this one. Okay, Berkshire Hathaway first bought shares of Apple in 2016 and has continued to buy shares. And its most recent purchases was in the first quarter of 2023. When Buffett and his team added 20.4 million more shares to bring the total to 915.6 million, those shares now account for about 48% of Berkshire's investment portfolio. There's a lot of Buffett to like about Apple. Its combination of hardware, software, and services give it a strong moat. Most recent purchase was in the first quarter of 2023 when Buffett and his team added 20.4 million more shares to bring the total to 915.6 million. And the moat isn't just against competitors, as exemplified by the iPhone 55 Plus market share for smartphones in the United States. Buffett said at Berkshire Hathaway shareholder meeting earlier this year that people would rather give up their car than their iPhone if they had to choose. Apple has been a long-time investor in AI, but you might not realize it. The company has a history of focusing on consumer benefits instead of the technology behind how it creates those game-changing features in its products. For example, AI powers lots of new features in the new iOS and watchOS, such as live voicemail, crash detection, and abnormal ECG detection. Apple is also starting to invest heavily in the forefront of AI development. Generative AI reportedly built its own large language model, and it's internally testing with its own ChatGPT style chatbot. As a platform owner, Apple has a tremendous advantage if and when it rolls out a generative AI application like a chatbot. Well, it can build it directly into the native iOS, macOS, and watchOS software that over 20 billion people around the world already use. That's a massive advantage that could present new revenue opportunities for Apple or simply make its devices that much more desirable. With shares trading around 29 times 2024 earnings estimate, Apple stock carries a premium compared to the S&P 500. However, with its massive cash position and share repurchase program, the stock deserves that premium. Investors shouldn't shy away from Buffett's favorite stock. Amazon 0.4% of Berkshire Hathaway's portfolio. Berkshire Hathaway owns 10 million shares of Amazon after giving its position a slight trim last quarter. The holding company first bought a stake in early 2019. Buffett previously lamented his inability to get a handle on the power of the Amazon business model and the value of the company as the big reason stopping him from buying the stock earlier. As a big reason stopping him from buying him the stock earlier, Amazon has built a strong foundation in AI innovation that can be seen throughout its operations. From product recommendation to supply chain management to its logistics routing, AI is essential to improving Amazon's bottom line. So it has invested heavily in building advanced algorithms. More recently, Amazon integrated more advanced AI into its Alexa voice assistant. Okay, but Amazon is also a big tech company investing in both hardware and software for generative AI. Its cloud computing business, Amazon Web Services, is helping more and more businesses bring AI capabilities to their businesses in and data analysis. It invested $4 billion in Anthropic, one of the leading generative AI developers. Anthropic subsequently agreed to use Amazon's Trainium chips to train its large language model in Amazon's cloud. Amazon's Trainium chips to train its large language model in Amazon's cloud. As a leading enterprise cloud provider, Amazon is in a strong position to capitalize on the growing demand for AI. Well, in its despite its high valuation, shares are so attractive because Tech Titan is showing improving margins and AI investment. Give it a lot of potential to outperform analyst expectations going forward. Okay. Hmm. Okay. Okay. Let's see. Okay. Let's go see Shopify. Okay. Hmm. History shows us bear market always lead to big bull markets. So it's a good idea to prepare. Even if you've never heard of Shopify, you probably have contact with the company on a daily basis. That's because Shopify helps many of your favorite e-commerce companies operate their online stores, providing a variety of services from creating the website to tracking sales and managing inventory. Shopify generates revenue in part through services to these clients, including payment processing fees. So when clients' revenue climbs, this is great news for Shopify. Most recently, wait, hold on. Shopify generates revenue in part through services to these clients, including payment processing fees. Most recently, Shopify said its margins of Black Friday Cyber Monday sales reached a record high of more than $9 billion. It's also important to note that Shopify is the e-commerce software market leader, with 28% market share according to Statista. So, okay, the e-commerce giant has demonstrated solid growth track record, and the most recent quarter gave us reason to believe the growth will continue. Revenue and gross profit advanced in the double digit, and the company was free cash flow positive for the straight quarter. For the fourth straight quarter. Okay, though Shopify has soared about 100% this year, there's still plenty of room for this stock to rise over the long term, and especially in a bull market. Has processed 812 billion dollars in global commerce since its inception, but this business still has a tremendous runway to explore within the multi-trillion dollar e-commerce space. As one of the leading companies providing software, hardware tools, and solutions that merchants need to start, scale, and build business both online and offline, across a range of industries, the need for Shopify's family of platform isn't easing. Over the last few years, growth has slowed considerably from where it was in the early days of the pandemic. Realistically, that was to be expected. Investors who scooped up shares of Shopify in those pandemic days and held on to them through the period that followed likely experienced some significant gains followed by bearish volatility. However, for long-term investors, what matters is whether it's a business that can sustain meaningful growth over a period of years, rather than a few quarters of unbelievable gains that would be hard to replicate over a prolonged time. Despite the fluctuations in consumer spending and the broader economy that is still posing difficulty for business like Shopify's, this e-commerce giant is harvesting cash. Profits are growing and revenue is steadily on the upswing. In the first 9 months of 2023, the company brought in revenue of nearly $5 billion, a 27% increase from the same period in 2023. It was not profitable when looking at 9-month period, but in the third quarter, it did turn back to profitability of $780 million under generally accepted accounting principle. Shopify recorded cash profit operating activities of approximately $500 million in the first 3 quarters of 2023. Ready for a connected TV boom. Roku was a big winner during the pandemic as investors couldn't get enough of streaming stocks and tech stocks. However, the stock crashed in 2022 as the digital advertising market ground to a halt. Roku has rebounded this year. Revenue growth started to accelerate again. Mm. Now, after 3 rounds of layoffs, Roku is back to reporting on adjusted earnings before interest, taxes, depreciation, and amortization profit. Roku's stock price has already more than doubled this year. But the stock is still down close to 80% from its pandemic era peak, showing it has more room to run. One reason to buy the stock in December is the emerging growth in connected TV or ad driven streaming. Streamers like Disney, Amazon, and Netflix are all among to grow their ad based streaming tiers, which should drive significant businesses toward Roku, as the streaming platform typically takes 30% of ad inventory from its streaming partners. Streaming platform typically takes 30% of ad inventory from its streaming partners. Additionally, the company should benefit from the end of the writers and the actors strikes, as media and entertainment is one of its biggest advertising channels, and Hollywood studios should be eager to reach audiences once again as production ramps up. Finally, holiday season tends to be the peak time of year in advertising. Roku offered modest fourth quarter guidance in its earnings report in November, setting the stock up for another leg up if it can top the guidance in its next earnings report. Let's go see what else do we have here. Hmm. Alphabet. Hmm. Okay, Alphabet's cloud computing product will provide significant growth. What would 2024 be solved for these three? Uh, Let me see the one with the Alphabet. Okay. What are these going to be solid 2024 picks? It's all boils down to artificial intelligence investing. Every fund manager and advisor wants to tell their clients they are investing in the best AI companies, which is why investors should exhibit some urgency in acquiring these stocks. But the reality is that these three companies are great long-term picks, not just because of AI. Alphabet is likely better known by the companies in Osh, Google, and YouTube. Among many others, Google is deadlocked in an AI race with its peers, including in cloud computing. The model behind the Gemini generative AI interface. AI is a huge opportunity for Alphabet, but its primary moneymaker is still advertising. Although advertising had a weak 2022 and early 2023, it's starting to trend up and is slated to hit its stride in 2024. These two factors combine to make Alphabet a top stock peak in 2024. Okay, this is it for today. Today we did YouTube for only about 22 minutes, but that's enough for today. And see you and have a good night, guys. Okay, bye bye, everybody. Bye bye.